Welcome back to another explainer where we bring a little bit of order to the wild, chaotic world of investing. Today, we're unpacking some truly rigorous research from the Economic Analysis Observatory, published in May 2026. Listen, if you've ever stared blankly at a stock chart and felt like you were looking at pure, unpredictable noise, you are exactly in the right place. Let's make some sense of it. So let's dive straight into the ultimate question, right? The one thing that truly separates the gamblers from the actual strategic wealth builders. I mean, everybody wants to buy low and sell high, but how do you actually know what low is without just throwing darts at a board? How do the pros strip away all the hype, the fear, the daily noise, and figure out what a business is actually worth? Here's a quick look at our agenda for today. 1. Order from market chaos. 2. The core valuation toolkit. 3. Sector-specific strategic insights. 4. Navigating scenarios and risks. 5. The psychology of investing. And 6. Disclaimers and next steps. All right, kicking things off with Section 1, Order from Market Chaos. Let's look at the evolution of investing. Think about this for a second. Prior to 1934, investing was kind of just pure speculation. People bought based on rumors and price trends. And then bam, the 1929 Wall Street crash wiped out literal billions. It basically forced the entire discipline to evolve out of sheer necessity. By 1934, Benjamin Graham and David Dodd came along and created security analysis, introducing strict mathematical safety to the game. Then, in 1958, Philip Fisher added a new layer, qualitative factors, like looking at management and competitive edges. And finally, by 1977, Warren Buffett started publishing his shareholder letters, bringing it all together by synthesizing Graham's hardcore math with Fisher's focus on sustainable, high-quality businesses. Now, I absolutely love this quote from Benjamin Graham's 1949 book, The Intelligent Investor. He introduces this metaphor of Mr. Market. He basically says, imagine you have a business partner named Mr. Market who shows up every single day offering to either buy your shares or sell you his. Some days the guy is wildly optimistic, other days he's just completely depressed and panicked. The strategic insight we need to take away here is that daily price volatility is a psychological phenomenon. You literally can never let Mr. Market's emotional mood swings dictate how you view the real underlying value of a business. Moving right along to Section 2, the Core Valuation Toolkit, the math behind the money. So what exactly is intrinsic value? Well, the most important thing to grasp is that it's completely independent of whatever the stock ticker says right now. It's just the number justified by the cold, hard facts. Think of it this way. If a business is a machine that prints money over time, intrinsic value is simply how much all that future printed money is worth if you held it in your hands today, minus a little bit to account for the risk that the machine might, eventually break down. To actually figure that number out, analysts rely on comparative multiples. These give you a really quick strategic insight into how the market is pricing a company's earnings or assets compared to its rivals. For instance, the P/E ratio tells you exactly what the market is willing to pay for one single unit of profit. The P/B ratio looks right at the balance sheet, which is perfect for heavy asset businesses like banks. And then EV/EBITDA looks at the entire enterprise. That's a huge one because it lets analysts compare two companies side by side, even if their debt structures are totally different. But here's the catch. Multiples only compare. They don't actually give you an absolute value. If you want a deeper look, you have to use a discounted cash flow, or DCF model. It involves 3 main steps. First, you forecast the total future cash the business will generate. Next, you figure out the WACC, the weighted average cost of capital, to act as your discount rate. And finally, you calculate a terminal value for all those years way out beyond your specific projection. It's a very rigorous process, but honestly, as the May 2026 research points out, it is highly, highly sensitive to whatever assumptions you happen to plug into it. Let's jump to Section 3, Sector-Specific Strategic Insights, because no, not all companies are measured equally. Okay, so here is a massive strategic insight. Fundamental analysis requires totally different metrics depending entirely on the industry. Take a traditional bank. Their literal raw material is money itself. You can't use a metric like EBITDA for a bank because interest isn't just some financing cost, it is the core product. So we focus heavily on price to book. But then look at a hyper-growth tech startup. They might not even have profits yet. So for them, analysts look at the cost to acquire a customer compared to that customer's lifetime value, along with things like the Rule of 40, which balances their crazy revenue growth against their profit margins. To put that into perspective, just look at this specific number, 4.5%. Under the global Basel III regulatory framework, banks are absolutely required to maintain a minimum of 4.5% common equity Tier 1 capital. That single rule completely alters how we have to view their balance sheet risk. You literally cannot run an accurate analysis on a financial institution without deeply understanding these strict regulatory minimums that dictate whether they stay solvent or go under. Which brings us nicely to Section 4, Navigating Scenarios and Risks, or as I like to call it, When the Math Lies. Seriously, what if the math actually lies to you? Believe it or not, it happens all the time. Investors constantly fall into what the research calls a value trap. Just because an asset has a really low price compared to its earnings doesn't automatically mean it's some amazing bargain. Sometimes it's cheap for a very good, very terrifying reason. This right here is the anatomy of a value trap. A stock might look dirt cheap on your spreadsheet, but if you spot any of these structural red flags, run. The business is likely deteriorating way faster than the price is even dropping. I mean, if an industry is just dying out or a company is losing its competitive moat to a slick new rival, those historical earnings you're basing your math on, they're basically a mirage. Plus, as the research highlights, management can make aggressive accounting choices that artificially inflate their profits, completely hiding the fact that they're bleeding cash. And we certainly can't ignore the big picture, macroeconomic risks. Let's say the central bank suddenly hikes interest rates. Well, guess what? Your discount rate immediately shoots up. And when that happens, the present valuation of all those future cash flows just collapses instantly. This is exactly why those high-growth tech companies, the ones promising massive cash flows decades from now, always get hit the absolute hardest when interest rates spike. All right, Section 5, the psychology of investing, the human wild card. Okay. There's literally a massive academic war going on in the finance world right now. On one side, you've got Eugene Fama's efficient market hypothesis. That camp argues that markets are perfectly rational, giant calculators where prices instantly reflect all available info. But on the other side, you have Nobel laureates Daniel Kahneman and Amos Tversky, the pioneers of behavioral finance. They proved that, hey, humans are inherently irrational. We are driven by deep cognitive biases that constantly distort our decision-making, which is exactly what creates mispriced assets in the first place. Because of this, understanding these portfolio-killing cognitive biases is an absolute game-changer. It's just as important as knowing how to read a balance sheet. Take loss aversion, for example. A financial loss actually hurts you psychologically twice as much as a gain feels good. That directly leads to the disposition effect, which is when investors stubbornly hold on to their losing investments way too long, just praying they bounce back, while selling their winning investments way too early just to lock in that quick feeling of success. Recognizing these biases in your own brain is absolutely the first step to overcoming them. And finally, Section 6, Disclaimers and Next Steps. Let's wrap this up. Before we go any further, a super important disclaimer. Please remember that this explainer is strictly educational. We're talking about the science of analysis here. It does not constitute investment, financial, legal, or tax advice. As the May 2026 Observatory report makes very clear, past market performance absolutely does not guarantee future results. You should always do your own rigorous research and talk to a certified professional before you make any financial moves. All right, so for the focused learners out there who want to keep elevating their strategic insights, your very next step is easy. Hit that follow button for the Macroeconomic IA channel right now. We are constantly bringing you the most cutting-edge information, covering everything from macroeconomics to artificial intelligence and technology. It's the best way to make sure you stay ahead of the curve. And hey, make sure you access all the detailed links we've placed down below so you can dive even deeper into today's research. So I'll leave you with this final thought. The market is always going to offer you chaos, right? There will always be noise, panic, and emotional extremes. But now, armed with the framework of fundamental analysis, you actually have the blueprint to find order in that chaos. So are you going to let Mr. Market dictate your wealth, or are you going to calculate the true intrinsic value? What will your next move be? Thanks so much for hanging out for this explainer. Stay tuned for the next one, and we'll see you soon.